everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I believe each and every one of you deserve to have a plan in life, whether it's a financial plan, college plan, tax plan, your business plan, a weight loss plan. Today, we're being joined by three superstars in the real estate world. I've got Jimmy Choi from Corona, California, Dan, your mortgage man, Nathanson from Boca Raton, Florida, and Jeremy.olsher from Boca Raton, Delray Beach. Real quick intros. Jeremy is with Compass. Yeah, I'm losing my notes already. Jeremy, Compass Real Estate Group in Delray Beach. He manages a team of over 12 agents. He and his lovely wife, Casey, just welcomed their new daughter, Isabel, to the family to go along with their lovely daughter, Genevieve. So congratulations to Jeremy and the growing family there. Jimmy's out in Corona, California. Jimmy spent many years as a Wall Street investment executive, managed assets in the multi-billion-dollar range. I hope you siphoned off a couple mil for yourself there, Jimmy. And recent years got involved with Allstate in the property and casualty space, and now has launched his own agency. Tell me the name again. Choi and Company. Choi and Company. Thank you. Again, he's out in Corona, California. And then Dan, the man Nathanson, he's from the Boston area. We won't hold that against him. He moved down here to South Florida in 1999. He's been in the mortgage and real estate industry. Oh, I reversed that. Sorry. Since he's been in the mortgage and real estate business since 1999. He's been in South Florida since 2003. He's a big Boston sports fan, but as a New York, New Jersey sports fan, we still love him to death. So, gentlemen, welcome to Ask the Planman. It's 2023. It's now February. I want to invite you guys in here to talk about the current situation with real estate. We got a little bit of a mulligan here, so I'm going to do the best I can to get these questions refreshed. So I want to kick it off with Dan, the problems that people are facing on the insurance side, problems people are playing with on the purchase price, buying and selling their homes, and obviously with the mortgages. So Dan, I'm going to toss it to you first. In the last 5-6 months, we've literally seen interest rates more than double. How are people combating the rise in interest rates right now? What can we share with them as far as some tips? What are you sharing with your clients regarding these recent moves in interest rates?
That's a great question. And one of the things that I like to share with people about is a temporary buy down of interest rate. Meaning, let's say, for example, someone today qualifies at a 6.5% rate. That's what rates are today, let's say. And they can get a credit or a concession from the seller specifically to be used to buy down the rate. And there are a few different options. There's a 3-2-1 buy down, a 2-1. And just so you understand what that means. So, for example, a 3-2-1 buy down is where it happens over 3 years. The first year of the mortgage, your rate would be 3% lower. So if they qualified at 6.5%, the first year their payment would be based on a 3.5% rate. The second year, their rate would be based off of a 4.5%. Right? No, so I got it backwards. Sorry, 4.5, 5.5, and then it would be 6.5 for moving forward. And it's a terrific option because projections are that, from Fannie Mae, Freddie Mac, the mortgage banker, everyone, are that rates will come down this year and next year. So if people can get in today into their home, have a lower rate temporarily, and then potentially refinance in a year or two when rates are lower, they're not really impacted by the high rates. It's a really terrific option to help someone get into a home affordably today.
So, Jeremy, how are you seeing that impact? Are you seeing that your buyers and or sellers are being a little bit more flexible and offering some assistance on that? Are they doing some givebacks yet? How are you seeing this change?
Well, with the higher interest rates, there's obviously always different ways to go about it, buy down points or whatnot, what Dan was talking about. But a lot of the deals here in South Florida are cash purchases. So I'm seeing probably 60% of the deals are cash. And this market we're in is kind of isolated and different because people are moving here in South Florida from all over the place. We're getting a lot of transplants from New York, New Jersey, Illinois, California. So the deal with the mortgages, unfortunately, the people who are getting mortgages, are going to have to be creative, and only sellers on properties that are actually sitting are going to be the ones who are going to, give the concessions to these buyers, because in our market now, single family homes with pools, with land, we're back in a position today where there's actually multiple offers and limited inventory. So it all depends on the buyer, of course.
Sure. Well, it seems that South Florida, as Jeremy kind of alluded to here, is we're in our own incubator because of the tax-free state income situation. A lot of athletes moving here, hedge funds have moving here, Wall Street money, what have you, because there's no state income tax. And New York and New Jersey, I told everybody to shut their ringers except me. Except,
hi.
Oh my God. Sorry. There's no editing here. We're just going to keep going. I don't even know who that was. I thought I shut it. The buyers down here are coming in with cash. There's high net worth buyers. The New Jersey, Connecticut, New York markets, the state income tax is upwards, surpassing 10%. So when you've got a hedge fund that makes $1 billion a year, $500 million a year, that's a massive savings to them. But the problem is that the majority of the people, the non 1%ers, the non 3%ers, they're still relying upon mortgages. And so there's areas where, again, this is not supposed to be a Florida show per se, but you got 2 of the 3 of us or 3 or 4 of us are from Florida, is what we're dealing with here. And then maybe there's a little bit of the reverse side with Jimmy out there, because California people are leaving. They're not necessarily moving in. It's one of those states where there's very high taxes. So Jimmy, tell us, as a polar opposite, I would think, what's happening in the state of the California markets and the West Coast of the country. How are you seeing things playing out right now? And then we'll come back into the Florida conversation.
I mean, it's exactly as you said. It's the opposite, right? So we have high taxes. California also has one of the highest home prices, right? So you're seeing a mass exodus of people leaving California. I think the past 2 years was the first time California had back-to-back years of people leaving more than people coming in, right? So there's definitely an exodus out of California, and we're seeing mortgages, people selling their homes, but at the same time, we haven't seen the home prices really drop. We've seen a small drop, a small dip, maybe 5-6%, but we haven't seen those 20-25% dips yet. So it's kind of what they say, it's a hard market, right? The home prices are high, and the mortgage rates are higher as well too now. So it kind of leaves everybody in a place where they can't buy a home when they want to. They can't really sell a home because no one wants to sell. No one wants to buy a home that's high and have a high interest rate as well too. So it's a difficult market in California for sure.
The phenomenon that's going on with the rise in interest rates is, I'm doing this 35, 36 years, and historically people are going to say these aren't very high rates. You come out of the 70s into the 80s when rates were 12, 15, even 18% mortgages. And then over time, 87 into the 90s, and then 2001 really started to move back down. But I remember refinancing my 7% mortgage into a 4%. And then we sat there for quite a long time with the housing crisis. So whereas my kids are now hitting their 30s, all they've known as their young adult lives, and I don't know what is technically construed as a millennial, is age-wise, but they only know one paradigm, and that's sub 4%, sub 5% rates. And so, yeah, you could say to a 60-year-old, 7% is still pretty cheap, and they'll bite down on it. But when you've doubled what your 30, 35-year-old has only known, and that's where this problem in history repeating itself is, we may go higher. I know Dan said that, the forecasts are that rates are going to go lower, but, certainly there's I think yesterday alone, they raised rates another quarter point, right? So rates moved a little bit by the Fed, and inflation is still running high. Gas prices are crazy, heating prices, oil, electric. I mean, inflation is up, the eggs, you name it. So what's going to drive rates back down? And ultimately, where our regime gets a handle on normalization, I guess that's where I want to go, is what's really normal, because we had an abnormal phase of 10, 15 years of really low rates, coming out of a decent cycle of normalized rates, coming out of a high cycle of the 70s. So how do we know we're not going to go back to double digit rates? We're saying 6.5 and 7, but what's going to happen there? A few months to kicking the tires between 6 and 7%. So how are people counteracting some of that rate increase, because it's been diminishing their purchasing power? Those who need mortgages, their dollars being stretched thinner. They can't qualify for as much of a purchase price as before. Maybe have to come up with more capital. But you've got some creative ways that you've been introducing with people. Why don't you tell everybody, our listener, a little bit about what other programs are out there?
Sure. It's a great question to ask, is how can you combat that? Because affordability is one of the biggest challenges right now in the mortgage and real estate world. And one of the tools that I use and I recommend and suggest to people is a temporary buy down of their interest rate. And it can be bought down for 3 years, 2 years, 1 year. The cost of it comes directly from the seller. So you have to get a seller credit or concession specifically for the buy down. And what it does is, if someone's whatever rate they're qualified for, let's say today at about a 6.5% rate, if they did a 3-2-1 buy down, their first year, their rate would be at a 3.5% rate. Second year, their payment would be based off of 3.5%. Second year, 4.5%. Third year, 5.5%. And after that, it would be at that 6.5% and beyond. And the thought is that with all of the experts forecasting and projecting that rates will come down this year and next year, that people get in at this temporarily lower rate and then next year or the year after refinance once rates have come back down. So that's really one of the best tools that I'm seeing right now to help people combat the high rates. But I've got to tell you too, I see lots of people that it just kind of is what it is. They need to make a move and they're doing it regardless of getting a seller credit to buy down. But that's a great tool to combat.
So I got two questions to follow up on that, and I'm going to kick it over to Jeremy. So A, with that buy down, what's happening to their amortization? Is it in a negative amortization at that point? Is that what the buy down's doing, is to kind of keep it whole, and the integrity is to keep it level?
It's amortized just like normal. Literally what it is the seller is paying the difference. That's really what it is. The credit or concession that the seller makes literally gets applied to prepaid interest. And the buyer, the borrower, is just benefiting from the seller paying that. So it's amortized the same way.
And so my second question is, from you as a mortgage lender, when you're looking at people's credit worthiness, the 28% of their income type calculation, are you working off of the 3.5% number to get them in the door, or is it really still factored off of 6.5%, which is their long-term number?
Yeah, good question.
So
it's at the higher rate, what's called the fully amortized rate. So they're qualified at 6.5%. That's how it works, and they just benefit from payments based off of a lower rate.
All right. So, Jeremy, you're on the buyer-seller side as the realtor specialist of the group. Are you seeing in our market here in South Florida, are you seeing the sellers that are dealing with mortgages, not your cash buyers, are you seeing them being willing to give some of those concessions yet?
Yeah, well, sellers are always deal makers if they're trying to sell a property and they're not able to sell it. So, obviously buying down a mortgage rate is going to cost money, and it could be all negotiated. The seller could pay it and the buyer gets the advantage of it. So this is a relatively newer program that the lenders are offering, considering rates went way up. So it's another way for lenders to be creative. And, for buyers, we ask for seller credits often. And, with these mortgage rates, it makes it more affordable for a buyer, in the first year, second year. The only issue that could happen is, if prices go down or, they lose their equity, or, it's going to be a lot more expensive to pay for that mortgage in a couple of years. But, if rates do go down, they could refinance, which does cost more money. So, it all depends on how much the seller really wants to make the deal, and educating the buyers and letting everyone know on the same page with the mortgage broker how this is all transpired.
So how are you finding the South Florida seller right now? What's the temperature down here? Now, again, hopefully I've got national listeners, and we got Jimmy out in California to pull in the West Coast, but the three of us are down here in South Florida. So we're kind of a unicorn in the sense of real estate right now. So how are you kind of seeing in our incubator here, Jeremy, the seller side? Is there the demand still the same, or are we seeing any kind of panic? Like what's the ratio of houses on the market to absorption? Tell us a little bit more about that.
Yeah, well, the peak of our market was just about a year ago, probably March 2022. So there was a big dip for the summer coming into this year, and all of a sudden it's picked up a little bit. So home sellers are, if they have the right properties, are not as worried as they were 6 months ago. But there is more inventory in the market, and the unique properties walkable to downtown areas closer to the beach or to a downtown area. Also, larger homes with pools, single family homes are selling. So it all depends on what the property is. But, since COVID, people are gravitating towards larger homes with bigger backyards and whatnot. And that's the way it's looking in our market. So,
we also
it's a very interesting time for sure, because condo sellers are having a difficult time, and prices are down further in condos than they are in single family homes.
So there's a difference there. So if somebody's looking for that turnkey location, 2-bedroom apartment, they're living there half a year, they want to lock the door and leave, they might have some different pricing pressure. But the single family home, pools, it was funny years back, pools were always kind of a hit or miss thing because a lot of people didn't want the liability. They didn't want the maintenance. And then when COVID hit, all of a sudden you had a pool. You were the local host of the whole neighborhood, right? People had a place to go. And then the demand for pools kind of picked up again. But Jeremy, off camera, we were talking a little bit about the cash buyer situation down here. So let's put that back into this recording. Where are we with that? What's the ratio that you're seeing? And then I'm going to tie it into Jimmy, because the phenomenon here is very different out in California.
Yeah, well, we are finding a lot of buyers coming in from out of state to Florida. So they're moving in a lot from New York, New Jersey, Illinois, Massachusetts, even California and other states. So a lot of these people have sold their houses there for larger numbers. And although the prices are still pretty high in Florida, you could still buy a pretty nice property for, $1.5 million, when in other markets such as California, you're going to be getting a shoebox. So We are seeing some of these people with cash coming in, just paying cash, outbidding for the preferred properties. And, there's not as many transactions going on right now because there's still limited inventory on the market. But the ones that are transacting, are certainly in the 50% or more cash in our market in South Florida.
So it's interesting because in my years on the financial advisory side, as I had my clients getting ready to gear up, 60s or so to move into retirement, and a lot of them, quote unquote, downsizing, whether physically or financially, coming to Florida was a move down in the sense of they could put money in their pocket. They could sell their house for $500,000 in central New Jersey, $1 million in northern New Jersey, and come down here and buy places in the $200,000-$300,000 ranges. Whereas now, 20 years later, those $200,000-$300,000 houses are $1 million homes.
For sure.
And in New Jersey, where they left, those communities maybe haven't been keeping up. So when I came down here, it was pretty much a lateral move 8 years ago to get out of where I was in New Jersey to where, into Boca Raton. And so now, COVID coming in, you had a price increases, people leaving New York City, going into the suburbs, and being able to telecommute, to then realizing, well, shoot, if I could telecommute from New Jersey, why don't I go to Florida and get out of the snow? And then so to also put in there, because we lost it on the previous recording, is New York, New Jersey, Connecticut, the top end income tax rate is 10% in their states. Florida has 0. So you come down here and you're making big money. Well, a cash buyer, they don't care. They want what they want. They don't care if they have to overpay $300,000 for it. If there's 5 places that meet their need and they keep losing them, they're going to keep raising their price. So the cash buyer is dominating the markets down here, and that leaves some problems for those in the middle market, the non 1%ers. And that's where the general population sits. So now, Jimmy, let's get you on here. you're out in California. You've got an exodus going on, whereas we're picking up a lot of those people, as Jeremy said. Tell us a little bit about what's going on in your part of the world in California, and how are people combating that?
Yeah, I mean, it's exactly it. They're moving out. That's how they're combating it. They're moving out. They're leaving the state. Home prices are still high. It hasn't dropped off as many as hoped or wanted it to. A lot of people were hoping for a correction of 20-25%. They've got more like a 5% correction. But then the interest rates went up from 3% to 6%. So you're looking at more home values where before you could get a 3,000 square foot home for $1.5–2 million. Now you're going to get, for the same price, you're going to get something on the monthly price. You're going to get something much smaller, right? You're going to get something like a 2,000 square foot home, or you're living further out away from Los Angeles. So people are leaving. And, like Jeremy said, people are selling their homes here for $1.5 million, where they have a condo, and they're moving to places like Texas or Nevada, where there's no state tax, and they're buying homes for cash, right? Because you can still buy a home in Nevada or in Texas for half the price, and they buy it in cash.
So, cash is king, and we've said it several times here, but not everybody owns a home to sell. Not everybody just walked away with $1 million net proceeds to then roll it into the next property. So it bodes the challenge of, my youngest is 28. My oldest is going to be 32, right? I got 3 boys. How does that generation compete and get involved in home ownership when they're dealing with these kind of headwinds? Their earning power is not up there to get 7% mortgage rate qualifications. They can't afford a $500,000 mortgage, right? A lot of them. And so who's getting squeezed out? And then add on top of that, the rental market has skyrocketed. So they're coughing up big money. They got to live with 3 or 4 of their friends to afford anything, right? Especially my kid that lives in New York City. And then, well, let's start there. Like, so how are we going to combat that? Like, where? Go ahead, Dan.
So, I mean, it's almost like you're leading me here. A great option that I talk with, especially younger buyers, about is buying a multifamily home. Buy a 2, 3, 4 unit home. Because if you intend to live there, if it's going to be your home too, you can buy with as little as a 3.5% down payment. And we can use the income from your renters to bolster your income. So that's a great way for someone who is younger or has lower income or just isn't there yet. If they're buying a primary residence, they can potentially put down, like I said, as little as 3.5% and use income from their tenants to help qualify. Those tenants most likely will be paying the majority, if not all, of the mortgage, so they can build wealth. And then a year, 2 years down the road, they can keep that property, put another tenant in there, buy their own home. And it's just a great, I wish, 30 years ago, I knew about this and I would have done that. It's a great way for people to get in and buy a home if they don't have the income necessary to support it on their own.
It certainly is a good way to get in, but the only problem is that investors are buying all the multifamily properties, and the multifamily homes that I'm seeing on the market are not getting great return rates anymore because of the investors that are buying that. In the past, they're like, hey, I want an 8 cap. Now you're seeing 2.
Right.
So it's
all right, well, break that into English for everybody. What is that? What does 8 cap and 2 cap mean?
Just how much money you're putting down and how much return you're going to get on your money.
Okay.
So people want to make money on their investments,
sure.
And these days it's very hard to find good investments where you're going to make a good return on your money because of the high prices, because of the high interest rates. When you're borrowing money, the numbers don't make sense anymore. So that's why people aren't selling, because they have nowhere to go, and buyers aren't buying because the math doesn't make sense.
You touched on the investment opportunity. So not that I'm against it, but I'm always about the devil's advocate, is to give people information of both sides of the coin. Okay. And so think of it this way, and this is stuff I've been thinking about for the better part of a year as prices were getting stupid crazy and rates were still low, of like, when does this balloon pop? So here's something to deliberate on. Let's say I'm able to find something reasonable that's a 4 unit. I live in one and I have to rent the 3. So to Dan, do I have to have all 3 places rented to qualify for that? Because they may not be rented at that point. So the math may not be there yet. But we're going back into the state of the economy, the changes in interest rates, whether higher or lower from here. What happens when my tenants start to lose their jobs? You're seeing Amazon laying off people. You're seeing Facebook laying off people. You're seeing a lot more companies tightening their belts now post-COVID, where they were hiring like crazy and people were working from home, and now you're being told to come back to work. And so what happens to that investor, my 30-year-old son, who's going to do this, and all of a sudden 2 of his tenants move out because they lost their jobs, and now he's on the hook. And so things are cyclical is really where I'm trying to get to. Is I've been doing this for 35 years. I've seen interest rates move up and down. I've seen real estate markets boom and bust. And so I'm not saying we're going to bust, but the investor and the young adult out there that's looking to get involved in these things has to understand the risk that what worked for the last 10 or 15 years isn't guaranteed to keep working. The cycles could change. They better be better financed, better capitalized. I mean, what happened in 08 and 09 with the 3% down deals? Equity got wiped out. People, right? Short sales and all of that stuff. Mm-hmm. So
it was a different world, though.
Yes and no. I'll argue, counterpoint is yes, in some sense. Liquidity is different. The printing of money is different. But again, look, if you're a student of the investment game, whether it's stocks, real estate, or gold, or anything else, the investment return always returns to the norm. And so if the stock market has a historical rate of 10% and has 3 years at 30% as an abnormal rate of return on that bell curve, it's got to return to the mean. In 100 plus years of investing, whether it's real estate or stocks, it reverts to the mean. So if you have hyperbolic growth in any asset class, it will be due for a contraction at some point to get back to normality. And so the last person in is the one that's going to tend to overpay, right? And then if you're going to lend me money with 3% down on a 4-family unit, and I can't pay the rent, and the market shifts, and Jeremy can't unload it because the investor market dried up, rates are 12%, the economy's in the toilet, you can't tell me defaults aren't going to start to fall into play again. So unfortunately, the cycles repeat, and the government hasn't learned. If they're offering 3.5% deals down again, it's going to open up opportunities for mischief, right?
I think potentially, but again, I think that you're kind of mixing things. Just so the 3.5% down, that's FHA financing, that's government insured financing that's been there forever. With the rental market, the rental market is high across the country. Rents have increased significantly over the past few years. Palm Beach County, Broward County, where we are, Miami-Dade County, over the past couple of years, rents have gone up almost 40% per year. It's crazy.
That's right.
Now, I don't anticipate that that's going to continue. Now, I don't have a crystal ball either, right? But again, when I talk to people about, 3.5% down, buy an investment property, along with that comes make sure you're saving money, make sure you have a great handyman, make sure you have a great attorney, make sure you have a great realtor to make sure that you're prepared. Now, unforeseen is unforeseen, right? Nobody has a crystal ball. However, if you go in prepared as best you can to move forward and succeed, odds are you'll be good. You can't determine the outside factors, what's going to happen there. However, it's a great opportunity to get in there because, again, what's going on today with prices and all that is not like 2008. 2008 was completely different than what's going on now. What's going on now is pandemic based, and shortage of inventory. What happened in 2008 was really avarice. It was greed. As people started buying homes, a lot of people were building homes like crazy, and they overbuilt. And everybody, I'm sure you guys saw, Jeremy, I'm sure you saw, because I know I did, lots of people, investors, buying properties and at new construction and all this kind of thing, going in, buying stuff and then flipping it and doing, they weren't investors. They were just taking advantage of a time. And a lot of them got caught in a bad situation because, listen, there were terrible things going on in the mortgage world. Terrible. Now, one of the good things to come out of the real estate and mortgage meltdown is that there's a lot more control. We're required to disclose everything, whereas before, lenders weren't required to disclose a whole heck of a lot. And there was a lot of crazy stuff going on back then, and there were a lot of people in jail for it, rightfully so. But today, things are a lot more controlled, and there are consumer protections, right? The creation of the Consumer Finance Protection Bureau came out of that 2008 meltdown. And again, I think that we're now in a much better place, much safer place than we were back then, if that makes sense.
Yeah, absolutely. So, Jeremy, we referenced it before, and that's supply. So the demand, again, we're not trying to stay hyper-focused on Florida as much as the rest of the country, what's going on. But what did take place in that 08-09 collapse was a shift in the real estate investment trust world, where I experienced it in the Phoenix, Arizona market, because my son was going to school out there when we were buying some properties. And capital money in and of itself, the Wall Street places were getting cheap money, and they were coming in and buying 10, 20, 30,000 homes in the Phoenix market that were short sales, foreclosures, and they just came in and feasted on that. And it happened in Miami. The high rises, all the cranes stopped. And you saw all these 50-story buildings just stop construction, and we're letting kids live there for free because they just needed occupancies. And now that it has all shifted. So the question, Jeremy, is the supply has been strangled by the investor side of these REITs that are never going to sell. These are going to be 100-year held investment trust products that are just going to keep renting and raise rents over time. And if they need to lower rents, they'll lower rents, and they're going to return. And so how are we going to combat that competition? We got to build more. People got to expand. Like what do you see is going to happen there? Because those, you and I need to move. If I get transferred and I got to go to Michigan, well, I got to sell my house, and you'll find a buyer and somebody will come in and take this property, right? So there's always going to be somebody who needs or is a motivated seller. But at some point when the sellers stop and everybody in the neighborhood is all owned by corporations in trusts, I mean, what's going to happen?
It's a great question. It's hard to know. In the last, since COVID, most of there's probably over 20% were investors. And these investors were buying houses after the crash of 08-09. They bought it all after the crash from their bottom. So yeah, we're going to have to build more homes in different areas in the country, and, have workforce housing. And, unfortunately for the younger generation, they're going to have to earn more money if they want to buy in an important market. Either that, or we're going to have to see some kind of a collapse in the economy. Because what I do see now is I do see that there are a lot of investors in our market. There is a lot of actual rental inventory. Prices are actually down from where they were, but still you cannot find affordable housing. So is the multifamily properties that Dan was talking about, there's always going to be tenants for those where the rents are lower. But these people who bought these mansions and turned them into Airbnbs and to annual rentals, the prices already are down 20% from the peak, and there's more inventory. So either prices are going to have to come down, and they are coming down on the rental side. And in 08, when the prices came down on the rental side, then the home prices came down afterwards. But there's so much money out there with investors that it's a very tough question to answer, but it really goes to, the young people are going to be moving to areas where the homes are cheaper, and newer homes are going to need to be built in our country in other areas that are not built up yet.
So,
yeah, there's not enough homes. Right. We still in the country, there's 4 months supply?
So let's tie in the next problem, which will be more in Jimmy's wheelhouse here, is let's talk about the insurance side of things, because the South Florida market has massive headwinds. And Jimmy, out in California, I know fires and mudslides. So tell us what you're seeing and dealing with from the auto and home insurance world there. We can kind of correlate it to the Florida markets, but we've done some episodes on the auto home, but where are you seeing the challenges here as we're talking about home prices maybe not dropping yet in correlation to mortgage rates more than doubling? And so the person who does need financing, they've got to also calculate the insurance costs and their property taxes, right? Dan looks at all three of those components. And so the challenge you and I have been facing on the insurance world is what? Is that they can't get coverage. Their prices have doubled. So what are you experiencing out in California?
So, we're experiencing a hard market in insurance. And this is one of those rare situations where, especially in California, none of the carriers want to write a home policy. And they're doing everything they can not to, right? So the underwriters are being a lot more stringent. If you have, or if that home has a water claim in the previous 5 years, you're not getting a home insurance. And if you're not getting a home insurance, you're not getting a loan, right? So it becomes that home only becomes available to basically a cash buyer. Even companies like Allstate, they're doing everything they can to not write an auto policy even. And they've taken off 50% of the zip codes in all of California where they do not want to write homes. So that's the situation we're looking at right now. And now a lot of the carriers are also saying, hey, look, we're not going to write anything that has a reconstruction cost of anything higher than $750,000. So if you're looking at most of the homes out here, that's, $800, $900, $1 million, you're not getting coverage from most of the carriers. You have some carriers that says, we'll only do it if you bundle it with the home and auto. And that's some of the nicer ones, right? Or if you find one, a lot of the carriers are saying you have to do single pay, and at renewal it's a single pay. Not too big of an issue if you impound your policy, but if you're one of those that don't impound it and you have to fork up $5,000 for a home insurance policy every year, that becomes an issue.
So just what the word impound, what does that mean?
So that's when your property taxes and your insurance is tied to your mortgage, and you
escrow. So like an escrowed. I think we call it escrowed, right? Okay. So okay, yeah. So obviously most people are on a budget, right? And they have cash flow, and so people are on monthly pay. And so you're basically saying the only way these carriers are really interested is to get the money up front. And they want the working capital in advance. They don't want to wait 11 months to get their last payment. And so, and I've done it. I've seen, quotes I've given out, and it's like, look, if you want to save 10%, pay the whole thing up front. And they're like, well, my rates really went up. I'm like, well, that's what's happening here. So here's how you could save. And it's like, well, now you got to decide, like, can you put the money together to make an annual pay and get a little bit of a discount? But you're basically saying it's not even a discount. It's you're not even going to get coverage.
Yeah, you're not even getting coverage. And, the underwriting has got a lot stricter, right? If you use your insurance policy basically within the past 5 years, you're not going to get an insurance coverage from another carrier.
And again, used it meaning put in a claim. You got a claims history. And not using it like I have it, but using it meaning I asked for money. I put my hand out and said, hey, Allstate, cover this damage, right?
Right. I mean, the problem was during COVID, a lot of people started using their auto insurance and their home insurance policy almost as a form of banking, so that, instead of using it for catastrophic losses, right? Even small little things, they would start putting a claim in, a $5,000, leak damage on your drywall. They would put a claim into insurance, and insurance would cover it. Well, guess what? That created such a big loss, of $50 billion in loss in California by all the insurance carriers, Now the insurance carriers are saying, we don't want to touch any of it. And it created a situation where insurance carriers are being a lot more stringent on their underwriting. And they're also raising the prices to double, triple of what it used to be.
Yeah. And just to clarify what you said a little bit earlier, for the listener that may not know this, if you're a cash buyer, you're not required to have homeowners insurance. You have a mortgage. Dan's going to get you a loan. The bank, whoever's giving you that loan, wants security and are going to require at least enough insurance to cover the loan, which, let's just say I bought $1 million house and I finance $800,000. Well, I got to have at least $800,000 of insurance. So maybe I don't buy the million, but then my $200,000 of equity is at risk. So it bodes the question of people are willing to give it the cash buyer, whether Jeremy's getting cash buyers coming down here in droves. We've got the same problems in South Florida that the insurance rates, the ages of the homes, the ages of the roofs, the claims history, same things that Jimmy's talking about in California is going on across the country is the insurance companies don't want the risk. So now you turn around and have a cash buyer, Jeremy, for $5 million homes. They've got a choice, right? They don't have to buy my $45,000 a year policy, but you want to risk a $5 million part of your portfolio? Like that's right. Jimmy, how many wildfires blew through last year and wiped out billions of dollars of homes that had no insurance?
Every year. And, the worst part is sometimes, they're budget friendly. Being budget conscious of their policy. So they didn't have enough coverage, right, on their home. So now they're stuck with no home, a balance on their mortgage still. And, that's the worst case scenario that you're going to be in. And the mortgage company, they're still getting paid their monthly, but this person has no home to live out of.
We're dealing with egg prices at $11 a dozen. Okay. We've got lumber. We had lumber shortages, toilet paper shortages. Now we're dealing with this egg nonsense. So it just seems to come in waves. Gas prices have more than doubled. They almost tripled and they pulled back a little bit. So we've got these surging sectors of the market that are just kind of keep punching the consumer in the stomach. This week it's eggs, next week it's bread, it's toilet paper. Like you want to eat, but you can't use toilet paper because you can't. Like, what am I supposed to do here? Right. So again, it's rhetorical, but like, what's the end game here? Like, where's the insurance world going to go? Where are property homes going to go? How are people going to be able to afford these things? How do I get a mortgage from Dan if I can't get insurance? Where does it fix? What happens?
I mean, insurance is, I believe in 2024, we'll start to see a leveling out and you'll see things coming back to, somewhat of a normal insurance price, insurance coverage once the insurance carriers start erasing some of the losses that they had and start being profitable again. But until then, stick to your insurance carrier that you have now. Unless they drop you, don't move, don't change. There's that saying that on ads everywhere, if you're not changing your insurance carrier or looking for new quotes every 6 months, you're doing yourself wrong. That's the worst advice possible right now. Right now is stay loyal, and the companies will, keep you on as for being loyal. If the prices go up, deal with those prices. It's better than trying to find somebody else and they're going to charge you 3-4 times that, right? So stay loyal, stay with the carrier until they drop you. And if it's not a catastrophic loss, don't file a claim.
You posted yesterday on social media. We won't say which place, but you posted something that said this year's lowest priced plan is next year's highest rate increased plan. And so the message in there that Jimmy was saying is, look, if you're shopping price and somebody's coming into the market, Bruce's Insurance is the new player. And I want to get some market share and I'm going to underprice and beat out my competition so I can get some people on the books, even though it might be a loss leader. Next year, I've got all those people in. I'm jacking the rates. They're going to vomit in their mouth, but guess what? They can't go anywhere else now. They're kind of stuck, right? And so, we always talk about there's price and there's cost, and you've got to know what you have. You have to be happy with what you have. The grass is not greener across the street in the insurance world sometimes, especially with newer names in the market, right? And so we're dealing with that. I deal with the blowback all the time. Is I have clients say, well, I found this deal over here, and it was this much less, and I'm like, okay, God bless, good luck, And then the next year they're like, well, they just tripled my rates. Can you take me back? And I'm like, no, you can't come back. Like, they don't want you now. So let me put a bow on it from the insurance side, and we'll kick it back to Jeremy and Dan. Is people need to understand that insurance is the combination of everybody's money in a pool. And the insurance companies take all those people and commingle those funds and then hope for a certain amount of losses to use that money and the returns they make on that money to pay the losses. And so when we get a hurricane down here that causes $50 trillion, well, all that money is going to get eaten up and paid out over time. And now that money has to be replaced, because when the next storm comes or the next fire, in your area, so people don't understand, like, well, why am I paying more for what happened in Sarasota or Tampa or Naples? And I'm on the West Coast, I'm on the East Coast, had nothing to do with me. Oh no, your insurance company's covering the state of Florida, and they just lost all that money and they need to make it back. And so, as Jimmy, you were saying, is the only way it's going to simmer down is for losses to stop and to be stemmed back. And so the insurance companies are basically saying, look, I don't want Jeremy's business anymore. I'm not taking Dan's business anymore. I'll offer Jeremy coverage, but he's got to pay me 3 times as much. What's Jeremy going to do? And Jeremy's like, he's like, well, I have a mortgage, right? I have obligations. Dan's going to cancel my plan. Like, people don't understand, like, they're legally bound to carry insurance, and Dan's mortgage people are going to go out and get coverage if you don't. And it's only going to be for the loan amount. It's not going to be for the full value.
And you don't want that forced placed insurance, because it's super elevated price, right? It's crazy. You don't want that at all.
I'm trying to think of some final questions in here, but any thoughts on what I know what I wanted to say before we wrap up. So, but Jeremy or Dan, did you have anything that you want to add in? I mean, we're tying in the insurance side of things, but from your seats, how are you dealing with the insurance complications that Jimmy and I are dealing with? How are you guys handling it?
It just goes on the huge cost of the price of the homes and the higher insurance costs. If your roof is older than 10 years, you're going to get Citizens Insurance. We were fortunate enough last year that we didn't get a massive hurricane. We did in Florida, but it wasn't even, it could have been a lot worse.
Right.
So, if people want to buy properties in today's market, you're going to have a lot of money. So it's just the fact of the matter. It's the cost of money is a lot. The cost of insurance is a lot. The cost to maintain a home is a lot. You want to buy a house that has a good roof, good HVAC system, good foundation. So you need to earn more money, and we're in America. There's opportunities here.
So
go out and put the work in and be an expert in your field. And for the young kids of today, there are fields that you could excel in and become an expert and make a lot of money that weren't around 20 years ago. So, it's a challenging time, and try to pay off your mortgage, and hopefully the real estate market will stay strong. But we don't know what's going to happen, and the market still has a limited inventory of properties. The junk sits, the good.
Mm-hmm. And I agree with that. And the forecasts that I see and read from really the top economists across the country are forecasting and projecting that we're going to see continued appreciation in home values. However, slower appreciation than the past couple of years, but still appreciation. There are predictions of some pockets that won't appreciate, right? I mean, that's just normal. And as I mentioned, the forecast is for mortgage rates to come down over the next year and 2 years. Real estate still, I think, is one of the best investments you can make to create wealth, because you get to live in it also. And it's a forced savings plan, right? If you're renting, you're paying a mortgage. You're just paying a mortgage for somebody else, making them rich. Whereas if you pay your own mortgage, between home values increasing, right? Hopefully the experts are right, And as you pay down the loan and put more equity in, that's yours. So it's definitely still a great investment and a great opportunity. And I think in the vast majority of situations, it's much better to buy a home than rent a home.
Well, I think you hit on it is everybody needs a place to live.
Correct.
So you have to determine, certainly based upon your stage of life, whether you're a young adult that's up and coming, and how can you transition yourself out of the renting cycle. We do episodes on car leasing versus car buying, right? Like leasing's a trap. You never get out of a payment. So what Dan's saying is if you own your home, you're paying yourself. Yes, you got some interest rate cost, but you're building equity. Even if the home doesn't appreciate over 30 years and stays flat, eventually the mortgage is paid off and you own the property. So there's an equity position there. And then as we all know, historically, it does appreciate over time and hopefully, keeps pace with inflation of some kind. So you've got to figure out your transition. Now, on the opposite side, as people are exiting the workforce, they're hitting retirement, the RVs have exploded, right? Especially during COVID, the RV market went stupid crazy. Mm-hmm. People were dumping their homes and just going on the road and living in the woods. And, they don't want to see, they're looking for Sasquatch and they don't want to get COVID from their coworkers. So you've had that demand, but again, that's starting to maybe simmer down. So I always question when I've counseled clients on their retirement and where they're going and they want to relocate, if it's Florida or somewhere else, is what's the timeline that you're going to be utilizing that property? If I'm a snowbird for the next 30 years, then renting may not be the right answer when I come down here. I want to find a place that's somewhat reasonable and affordable and maintain 2 homes if I'm certainly relocating. But if I'm transition in an industry or a business that's constantly moving me, how often and frequently, people who are in the service, the military forces, work always on the move. And they got affordable housing and they were getting housing allowances, but every 2 years they were moving, right? And so if I've got to pay exit costs, moving costs, I'm not getting subsidized by my worker, like that gets costly. So people, they become perpetual renters, right? They don't, because they're not taking roots. So part of that decision making for the young adult that's listening is where are you in your career? Where are you in location? Are you sitting somewhere where you went to college, but you lived and your family's across the country and you're ultimately going to go back to that side of the country? Or are you really going to make roots there? And if you're going to make roots there and you're committed to staying, then the faster you get with Jeremy and get a place and build that equity, it doesn't matter what the rate is. It doesn't matter what the insurance cost is. It's going to be the better decision for you in the long run. And the hard part for a 25-year-old is to understand what long means. Mm-hmm. And go ahead.
I was going to say, for the older generation too, by the way, reverse mortgages are a great option for the right people. They did get a bad rap back in the day because they were not a good product and program back then. Now it is a government insured program. And if someone's 62 years or older and, these people that are moving from, let's say, New York, New Jersey down to Florida that sold their house for $1 million and now they're flush, if they want to buy a $500,000 home in Florida, they can put a $250,000 down payment, give their money to their financial advisor, earn money that way, and by the way, not have a mortgage payment. With a reverse mortgage, they still have to pay their taxes and their insurance and their association dues. But with the reverse mortgage, they don't have a payment. They can potentially even get money every month. And it's not the situation like it used to be where, it's bad for the family after the people pass away because they don't get the house. Well, there are options now. Either the family can refinance it, they can sell it, or it goes back to the bank, right? It's a great option for the older generation too. Right. In those certain circumstances.
All right. So not to steal the fanfare, but we're going to do an episode on reverse mortgages for our listener out there.
Yeah,
so it is on the plate. So no, it's good. I've been working to get somebody on here because yes, it's an absolute. People don't want to give up their homes. I'll just put a stamp on what Dan's saying here. Is people don't want to give up their homes, especially as in a couple situation. It's their home for 30, 40 years. The equity has built up. And then they don't necessarily want a payment because they're on a fixed income and there's all this equity. And I used to say to them, well, you can't sell that third bedroom and you're not using your dining room. So why don't you sell that off? Right. So if I have a portfolio of stocks and mutual funds, I can liquidate a piece of my portfolio to get capital. But most people's biggest asset became their real estate, is their home. And unless they're willing to move and downsize, you can't just sell off the dining room. And so the reverse mortgage became a way to do that. But
great for refinancing and purchases. Mm-hmm.
Absolutely. Absolutely. All right. So, gentlemen, it's been a pleasure. Any closing thoughts? Let's go around the room. Jeremy, any last tips or pointers you would give our listener from your seat? So I'll go with this. So you've experienced the bust. You've been in this long enough, right? So you've experienced that downturn. So what lesson did you learn from that? As you're saying, save your money and get ready to buy. But what would you say was one of your biggest lessons from what happened the first time, in case we wind up in that cycle again? That you would prepare your investor, your client. That's the people listening here are your potential clients. What would you be sharing with them you learned? Perfect. As we use the term, keep your powder dry, have money and capital ready to go, because opportunities will always present themselves, whether it's a market correction, which we look, I mean, again, we're recording at the beginning of February. The stock market has pretty much retraced from the lows it made at the end of last year. We had a negative year in 2022. And lo and behold, you look at the indexes and the numbers are basically within striking distance of where we were. So if you had dry powder and you had money during that correction, I'll just use, I think one of them was, let's say, Netflix. Netflix got slaughtered. And I looked at the chart the other day, they're up over 50% from their lows. So if you knew when to get in and you had dry powder, you had capital to pick up Netflix as it was bottoming out. Nobody knows how to time the market, but now you're up 50%. So if Jeremy or Dan or Jimmy has and sees real estate in a position where there's an opportunity, whether it's a 4-bedroom coming up or you got a quick sell or there is a correction, are you ready and going to have dry powder to move? So great points, Jeremy. Dan, how about you?
Yeah, great question. And everything I'm reading and listening to is that there's not a correction coming up. Everything I'm reading and listening to is that, like I said, slower appreciation and rates come down. I agree with Jeremy, though. Plan well, budget well, buy a home so that you're building wealth for yourself, right? The vast majority of people that I'm sure we all know that have money earned it through real estate. That's the vast majority. Like Jeremy said, historically, it proves to be a great investment, and it should be one of the investments that you have. Just put away that money, and when you're ready and Jeremy has a great property come up, talk to him, buy that property. Talk to me. I've got a great investor loan that's a great opportunity too. But yeah, just plan well, save well, and be ready.
Jimmy?
Yeah.
Words of wisdom.
Stay with your company. Be loyal to your company. You'll get that loyalty discounts even from other carriers. Stay with them for at least a year. Underwriters are seeing stats where people who stay with their carrier for less than a year, they're the majority of the 90 to 105% loss ratio. So they don't like you and they will rate you higher. So be loyal to your company. Use your policy for catastrophic losses only. If it's something that you can fix using your credit card and using your bank account, use it. Don't use your policy, and have the proper coverages on your insurance policy. You can do all the planning, and all of that can go to waste if you have the wrong insurance policy, and all that goes right out the window. All that planning that you did goes right out the window if you don't have the right coverage.
I'm sorry to cut you off. So quick anecdote to Jimmy's point, folks. So somebody that I know sent me over his auto policy and he had a 50% increase. He's like, why'd my rate go up so much? And he's not with me. He wants me to shop it for him. So we're shopping it around and we pull his claims history. And this is like last week. And well, he's got a claim for a cracked windshield last month in December. And he was with a captive agency with an S and an F. We know State Farm. And so he's with State Farm and he's like, look at my rates. Like, what do you have? And so, of course, we have nothing better because there's the claim. So Jimmy's saying catastrophic. He didn't total his car. If he's driving a Lexus for $50,000, he didn't total the car. He had a $1,500 windshield repair and he put in a claim. And so I said to him, and this is my so what, is didn't you call your agent to discuss this before you put in the claim? And he said no. He just put in the claim. And now he got zapped. And so you want to call Jimmy, you want to call your insurance agent anytime you have a potential claim to discuss it so that Jimmy can say to you, look, Dan, you can put in this claim, but I'm telling you, your rates are going to go up threefold for the next 5 years. Is it really worth it for that $1,500 repair that you're going to spend an extra $2,000 a year on your insurance? Well, no, the math is simply no. So when Jimmy's telling you catastrophic, like unless your car is being totaled, really the point, I don't care what the circumstance is, speak to your agent before acting on a claim because it is impacting you. It's going to impact Jeremy trying to get you your home. It's going to impact Dan trying to get you your mortgage. You're going to get declines. You're not going to be offered coverage. I have realtors coming to me all the time. I have mortgage brokers coming to me all the time. Can you help my client? And no, like the property or that person's history is coming with them. You just left your old house with 16 claims. You think the new buyer, the insurance for the new buyer doesn't know what you just did in your old house? It's going to follow you. So you're carrying your baggage. Any closing thoughts? Gentlemen, this has been awesome. Any other closing thoughts?
Yeah, I just say, just based on what you just said, the right answer, I think, is to have your experts and ask them for their advice and guidance. There's a reason that Jeremy's successful, that Jimmy's successful, that you're successful, that I am, is because we're really good at what we do. And so when somebody has a question, they should come to us for that, right? I'm not going to pretend to be an insurance agent or a realtor. I'm going to be in my lane. And when I have questions, I'm going to ask my experts. I'm going to ask the plan man. That's what it is. Use your team.
A quick question for each of you. Jeremy, does it cost anything to talk to you?
No, it's free consultations.
Dan?
I mean, you have to love the Red Sox. Is that it? No, nothing. Just a little bit of time.
Jimmy, does it cost any? Are you an attorney? Do you guys bill by the hour to talk to people? No, right, Jimmy? No. So folks, listen. It costs nothing to seek professional guidance in our space. We're not attorneys and accountants that are going to bill you by the hour. If you're not sure, speak to your professional. We always say, don't go it alone. That's why we're here with the show. That's why we're bringing you people that have got a combined, how many? You got 18, 20, 40. We've got 75, 80 years of experience sitting on this panel today. Okay. We've been around the block. We know our space. Seek us. Last but not least, gentlemen, I'll go Jeremy first. Contact info. We're going to put it in the show notes. How can people reach you if they want to discuss anything in the real estate buying or selling side of things? Jeremy, how can we get a hold of you?
Well, you can always find me online. You can Google me, Jeremy.olsher. I work with Compass, Florida, and I have a team. The team is the Mizner Residential Group. So I have a website you could log into. It's mizrr.com, and you could log in, and one of my agents will get back to you shortly. But 561-400-3737, jeremy.olsher@compass.com. And Bruce, thanks for having us on the show.
Absolutely. Your mortgage man, Dan.
That's me. You just did it right there. So, right, yourmortgagemandan.com is the website. You can find me on social via Your Mortgage Man Dan. And the best number to contact me is 561-948-1591. Your Mortgage Man Dan here. Thank you so much, Bruce.
My pleasure. How about you, Jimmy?
choiandcompany.com, and all my numbers there, my mobile numbers there, and you can use the website to contact me directly through the system.
CHOI for Choi, and Olsher, OLSHER. And for those of you who are struggling, Dan, DAN. Ladies and gentlemen, thank you so much. I want to thank my guests, Jimmy, Dan, and Jeremy today for joining us. We hope you got some valuable information on here. Now, we need your help. Please like, subscribe, and share our episode today. You can find us on planman.tv for YouTube, your favorite podcast channels, Apple, Spotify, and beyond. We're on 38 different podcast stations. Please like, share. If you need some advice, always get it right. Come ask the Plan Man. Give us a call at 844-PLAN-MAN. Find me at bruce@asktheplanman.com, and always our website, asktheplanman.com. Again, thank my guests, too many J's here. Thank my guests, Jeremy, Jimmy, and Dan. Thanks for listening, folks. We'll see you next time. Gentlemen, thank you so much for your time today.
When you need some advice, never sacrifice, always get it right. Ask the Plan Man. Finance, insurance, and more.